This is Robert Kraft, and I'm your host for SNN.Network, as well as the Planet MicroCap Showcase Virtual Investor Conference. And I'm very pleased this morning to introduce to you one of our virtual keynote speakers, Mr. Rick Rule. He is the Senior Managing Director at Sprott Inc., as well as the President and CEO of Sprott U.S. Holdings. I've been interviewing Rick for over 10 years now, and I've only been in the business for 8. Terrible joke, but at the end of the day, Rick is my go-to source for everything having to do with natural resources. He's been at the game for many, many years now, and we're so pleased that he took the time to do this. So without further ado, Rick, the floor is yours.
Robert, thank you for the opportunity. I'm pleased to note that you're the second generation of Kraft that I've been doing interviews with all this time. I'm delighted to be able to address your audience. I'd like to thank you personally and SNN for doing this sort of virtual discussion, given that we can't do our physical conferences at present. So thank you. It's particularly timely to be able to talk today and in this circumstance about precious metals, because this is the sort of circumstance where, pardon the pun, precious metals always shine. Gold, and to a lesser degree silver, have always been the ultimate money in times of stress. It's important to remember the reasons why before we go on to talk about how. Money is a medium of exchange, but mediums of exchange that are simultaneously stores of value are very rare. Traditionally, gold hasn't been able to be counterfeited. It hasn't been able to be printed. It isn't merely a promise to pay, which a check or a credit instrument like a dollar is. It represents payment in and of itself. It has value and it has utility that isn't by proxy. A dollar bill is in effect a call on faith and the goodwill of the American public. And at times like this, that goodwill seems to be less valuable than when they were making few of them. Remember, gold and silver cannot be quantitatively eased. So let's take this discussion in two fashions. One, let's discuss physical precious metals, that is owning gold or gold and silver and or owning their surrogates, exchange traded physical precious metals. Let's talk about why, let's talk about how, and then let's move on to the gold equities. It's important to note, first of all, that historically gold ownership has been viewed almost as an insurance or liquidity asset, rather than as a sort of an investment or trading asset. People expressed concern 3 weeks ago when in the immediate aftermath of the financial circumstance surrounding the coronavirus, that the gold price didn't skyrocket. The reason it didn't is because gold fulfilled its function for the people who owned it. When people scramble for liquidity, when credit disappears, everything that has a bid gets sold. And gold had a bid, a deep bid to sell into. Gold served itself extremely well. It even served itself for speculators. Sprott has information that suggests that 3 or 4 weeks ago, there were $60 billion in leveraged long gold futures contracts. Some of those leveraged as much as 33-to-1. When credit disappeared overnight from the trading desks and from the big hedge funds, those credits needed to be unwound, which means gold needed to be sold. Because gold had a bid, it was able to be sold. It's important to note that gold did what it was supposed to do. It's important to note, too, that if you look back at the history of various liquidity panics and crises, including 2008, 2000, and 1997, that gold did not move up in the immediate aftermath of the crisis, but rather moved up substantially when the policy implications of the crisis came to fore, which is precisely what gold is doing now. Remember that immediately in a liquidity crisis, nothing moves up other than individual investors' debit balances. It's the policy response to a liquidity crisis that makes gold move up. And gold is doing that now. 3 factors that investors and speculators, and for that matter, common citizens, need to think about in the current context with regards to gold. Because make no mistake, the policy implications, the policy response by governments around the world to the liquidity squeeze will be bad for many asset classes, and if passed as prologue, will be good for gold. Let's look at the first circumstance, quantitative easing. Estimates on the amount of newly printed currency in speculation by governments around the world are now about $10 trillion, which is to say that governments around the world have been rapidly printing or keystroking currency units that are backed by nothing. To understand quantitative easing, I think it's important, particularly for younger viewers, to understand a simpler word that describes quantitative easing better. That's counterfeiting. This is absolutely debasing the currency. What you do is you inflate the float of the currency by $10 trillion at the same time that the value of the underlying economy that in effect secures the currency goes down. So make no mistake, quantitative easing is debasing the currency. Gold moves up because people believe that the purchasing power of other savings instruments denominated in fiat currencies is challenged. In the United States, where estimates of quantitative easing now exceed $6 trillion, it's very difficult to see a way that the value of your US dollar denominated savings could not be debased by the injection of 6 trillion trumps, 6 trillion pieces of counterfeited currency. But it isn't merely counterfeited currencies and the debasement of the medium of exchange, in our case, the US dollar, that are problematic. The instrument of savings in the United States, and in fact, the instrument of savings around the world, has been US Treasury securities. In fact, the world's benchmark security, the security against which all other securities traditionally are priced, is the US 10-year Treasury. And the US 10-year Treasury has really three attractions. One, it is the deepest and most liquid investment market in the world. Getting on, getting off US Treasuries is a snap because they are so liquid. But the second is, of course, the credit aspect. The US 10-year Treasury is an obligation of the United States government and an obligation of American society. If you want to know what it's backed by you, your chattel. The tax receipts that they can take from you is really the backing, the way that you service that. Now, this is interesting because in addition to quantitative easing, the US 10-year Treasury is increasingly challenged by the balance sheet of the debtor, that is the US government. Many of your listeners may not know that on-balance sheet liabilities, that is the outstanding bonds that compete with your holdings of US 10-year Treasuries, now exceed $22 trillion. That's 22 with 12 zeros off it. And the off-balance sheet liabilities, these aren't bond debts, but rather entitlements, things like Social Security, Medicare, Medicaid, pension obligations, things like that. Promises that society has made to each other now exceed $120 trillion. In other words, the debtor, the US government, is in debt in excess of $120 trillion. And Robert, that debt doesn't include state debt. It doesn't include local debt. And it doesn't include unfunded pension liabilities throughout society that are supposed to be off-balance sheet guaranteed by the federal government. The aggregate indebtedness is really scary, but the way that we propose to pay that indebtedness, I would suggest to you, is scarier still. You see, we service this federal debt with the national income. The national income is taxes and fees less expenses. The problem is that the national income is in deficit. This year, the budget deficit may very well exceed $2 trillion on top of a $1 trillion deficit last year. I will ask your younger viewers who have studied new math at school if it is possible to add a column of negative numbers and come up with a positive sum. I don't know how one would do that, But one must say, given increasing calls on the Treasury and the level of debt and deficit, it is very likely that the Fed's only alternative will be to print their way out of the current circumstance. But that's not concern enough. We've learned that the currency is being debased by quantitative easing. We've learned that in the current political situation, this debt is unserviceable. The third problem, I think, with the US 10-year Treasury and other Treasury securities is that we have artificially low interest rate. The coupon on the Treasury has always been the government's way of compensating you for renting your money and taking a risk with regards to the ongoing purchasing power of your currency. The US 10-year Treasury currently yields about 60 basis points. That's 0.6%. The government itself acknowledges via the CPI stated rate of inflation that the purchasing power of your dollars is depreciating by 1.6% a year. So they promise to give to you 0.6%, and they promise to take from you 1.6%. Robert, take note. This is the first time in your life that your government has told you the truth about anything. They absolutely promise, if you give them money, to give you back less than you gave them. Jim Grant goes so far as to call the US 10-year Treasury return-free risk. And it is this US 10-year Treasury that gold is competing against. I think return-free risk is an opponent that gold can beat. It's important when you look back at history in circumstances like this, and not just in our culture, but in other cultures, that gold has moved as a consequence of fear in the ongoing purchasing power of currencies and of sovereign savings instruments. The gold stocks have traditionally lagged. That's because gold is bought by fear buyers. It's bought by savers. And gold stocks are bought by investors. Remember that gold stocks represent companies. And in a declining share market like we've seen, you come to understand that gold shares are ultimately shares too. That's why the gold shares sold off in the immediate aftermath of the financial panic. And it's also why there is almost always a delay between the increase in the gold price and the increase of the shares of gold producers. Make no mistake, this increasing gold price that we are seeing will benefit the gold companies. The truth is that gold stocks normally move when the increase in gold price shows up in the operating statement, the financial statements of the mining companies. And this move in the gold price that we've seen this year from sort of $1,200 to $1,700 will certainly be reflected in the operating statements of the gold mining companies, particularly those companies that operate outside the United States. I say that, you see, Robert, because the US dollar is doing well relative to other currencies. So if you produce gold in South Africa or Canada or Australia, your costs are denominated in currencies that are falling, meaning that your real costs are falling, while you sell your product for US dollars. The margin producing outside the United States is greater than you might otherwise imagine. Further, and it's important to remember this, the very low oil prices that we're currently enjoying, I say enjoying unless you happen to be an oil stock investor, but the current low oil prices that you're enjoying means that the operating cost for gold mines, which are enormous energy users, are falling at the same time that other inputs are falling due to declining currencies. So we're setting up what I suspect to be a perfect storm in the gold stocks. Increasing gold prices, reduced cost, and reduced cost in terms of energy, of course, with the traditional lag. Let's talk about what to do. The first thing is, if you believe the gold price is going to go up, and I do, you buy some gold, some physical gold. Buy it for insurance purposes. And Robert, even at your age, buy it hoping it doesn't go up in price too much, because any form of insurance is one that you're nervous about being paid off on. If you think about life insurance, it meant that somebody died. If you think about auto insurance, it means you had a wreck. When gold really, really, really moves in price, it means that we've had catastrophic social circumstances. Buy gold anyway, it'll come in handy. Remember too that silver is the poor man's gold. Traditionally, gold moves first because it's bought by fear buyers. But when gold establishes underlying momentum, silver moves later, but traditionally moves further. So investors and savers buy gold, speculators buy silver. Now, let's look at the gold stocks. In my experience, traditionally, gold stocks are one of the most cyclical, volatile asset classes in the world. I will make available to your listeners who contact me, and I'll give you the contact information later in this interview, a 45-year gold equities chart published by Barron's Magazine. I use it because it's the most comprehensive and also the longest running gold mining equities index that I have available to me. And looking at that chart, which, as I say, I'll make available to your listeners, shows some very obvious lessons. The first is the periodicity of declines. Remember that we said this is a very volatile asset class. What you will see immediately is that the decline that we are now coming out of, I believe, has been 7 or 8 years old. Historically, this is an extraordinarily long oversold bottom, telling me that we are almost at the bottom, or as I believe, just off the bottom. The second thing that you see in the chart is that there have been 8 recoveries historically from oversold bottoms since I've been in the business. This will be the 9th. And these recoveries have yielded index returns, not returns on an individual stock, but a return on the equity index that has varied between, I think it's 180% on the low side and 1,200% on the high side, which suggests that if past is prologue, that one can look at very, very, very substantial gains in the gold stocks. There's no guarantee, of course, that history repeats, but the chart makes a wonderful, wonderful case for periodicity and also for the incredible upside leverage that's in these stocks. I'd like to, having, I think, made the case for gold mining stocks, to talk a little bit about the tactics. For investors who are underinvested in gold and gold stocks, one starts your portfolio by owning the best of the best. The temptation, of course, is to take all kinds of risk early on, because taking the risk gives you access as opposed to a guarantee of absolutely almost fictional returns. But the truth is, when the index itself can yield you between 180 and 1,200%, buying the best of the best is the good beginning strategy for a couple of reasons. You don't need to outperform an index that's going to give you those kinds of returns. You just need to participate in it. And the idea that you would participate in the lowest risk part of the sector, the 4 or 5 best gold mining companies in the world, is the way that you start your portfolio. And those stocks move first. When the gold bugs who have been beaten up in an 8-year prior bear market come back into the market, they come back in tepidly and they buy the best of the best. And when generalist investors get hold of the gold narrative and come into the gold equities, they buy the biggest and the best and the most liquid first. So the best of the best move first. Then what I call the best of the rest, big companies, but not great performers. People who might be slightly higher cost producers. Ironically, the inefficient producers, the higher cost producers, enjoy better earnings leverage when the gold price comes up. It's odd how that works, but the truth is that a real bull market rewards the less efficient producers better than it rewards the best producers. So remember, best of the best, then best of the rest. In this market, another theme that gold is looking at carefully, and your listeners who pay attention might want to look at, are takeovers. Make no mistake, the biggest mining companies in the world are suffering from an inability to replace reserves. And the only way that they can grow, in fact, the only way that they can avoid going extinct, is to take over other companies. In the capital markets that we're in today, size and liquidity matter. The biggest mining companies in the world have both size and liquidity, and so they trade at higher multiples, which is to say they have a lower cost of capital. And in a capital-intensive business like gold mining, the lower cost of capital wins. Similarly, single asset companies are viewed as being more risky than multiple asset companies, because they are. The multiple asset companies trade at higher multiples than the single asset companies. So takeovers will happen. Companies with lower cost of capital will take over companies with higher cost of capital, and multi-asset companies will take over single asset companies. And this is all good. If you own a company that's going to be taken over, you get paid immediately. If you own a company that does the takeover and the takeover is accretive, you get paid in time. This is a wonderful circumstance. So for sophisticated investors, begin to play the takeover game. Of course, Sprott would like to help you if you believe that's appropriate. Then there are companies which I laughingly call the growth golds. Junior producers, not million-ounce producers, but maybe 500,000-ounce producers, maybe only 200,000-ounce producers. Companies that are financially solvent, have good operating earnings, and also have project development pipelines built in so that they can grow using their own resources, not needing to come back in capital markets. Right now, from our point of view, the growth golds are concentrated in Australia. But the truth is there are 5 or 6 companies that are worth looking at if you can take the sort of more risk than is inherent in buying the best of the best. Later in a bull market, I don't know when it'll be, 6 months from now, 12 months from now, 18 months from now, the emphasis will move from producers to developers. Companies that are permitted and financed and are finishing up or embarking on construction projects that will allow them to be re-rated and perhaps taken over once their cash flow starts. It's unlikely that those stocks move now, but as we move into a mature bull market, those companies have very, very explosive upside. And finally, of course, the most dramatic moves that we will see in this market will be the explorers, the companies who make discoveries. When the market is already red hot as a consequence of performance and a movement in the gold price, and the developers have moved up dramatically, the last to move, but the ones who move furthest are the explorers. And I need to say the successful explorers. To the extent that you participate in the exploration market, you must be prepared to do some work. There's all kinds of stories, but very few good stocks. The upside associated with the very good stocks adds respectability and sometimes even luster to what is in fact a very perilous market. So participate, but if you participate, be prepared to do the work. And then finally, the most aggressive asset class that we know in the sector, which is silver stocks. There's a very constrained supply of high quality silver stocks. Silver moves after gold and silver stocks move after gold stocks, but they move the furthest. Our mutual friend Doug Casey once told me that when the generalist investor comes into the mining stock market, the flow of investor cash into the silver stocks is the equivalent of trying to siphon Hoover Dam through a garden hose. It's an extremely pleasant circumstance for those who were there ahead of time. So let's recap. There are several factors which suggest that the gold price itself will go higher. Quantitative easing, or as I call it, counterfeiting, debt and deficits, and artificially low interest rates. All of those are good for gold, and all of those aren't on the horizon. They are with us today. In fact, we can see them in the rearview mirror. Gold moves, then silver moves, then gold stocks move, then silver stocks move. Silver stocks, at least the highest quality ones, moving the furthest and the fastest. I promised earlier in this interview that I would make available to your listeners, your subscribers, and your viewers a couple things. The first is the Barron's Gold Mining Index, which I will happily send to anybody who contacts me. The second is a 100-year commodity chart, which will prove to you just how cheaply commodities are in a historic context. By the way, I'm not expecting a commodities bull market for another 2.5 years. I think the precious metals market comes first. But then I think there's going to be a rebound in commodities that'll be truly spectacular. The most important offering that I have, however, is that I will personally rank the portfolios of everyone who watches this video and who emails me. I will rank your natural resource companies. You must put them in the body of the email, not as an attachment that I can't open. And you have to make it easy on me. You have to put the names and the symbols in text. I will rank them 1 to 10, 1 being best, 10 being worst, and I will comment on those companies where I think my comments have value. you may contact me at rankings, RANKINGS, at sprottglobal.com. Several thousand people have taken advantage of this offer over the last 6 months, and it's the most important educational circumstance, educational aid that we can give our viewers. So once again, we will rank your stocks, names and symbols in text, please. Address it to rankings, RANKINGS. We will include the gold mining index chart, and we will also include the commodities chart. Robert, thank you so much for this initiative. We're delighted to be able to participate in this circumstance where we're all shut in and looking for information and opportunity.
Rick, thank you so much again for joining us to do this virtual keynote. And I look forward to our next chat. And please stay safe.
Make the chat soon, and you stay safe too.